Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubow.
Welcome back, folks. Today, our special guest zooming in from Florida is a very accomplished real estate investor, and in his first career, he was a professional baseball player. So, baseball player turned professional real estate investor, Jason Postill. Welcome to the show. Great to have you.
Hey, thanks, Dave. Thanks for having me on. Really appreciate it.
So, Jason, big step going from baseball to real estate. And these days, you're focused primarily on mobile home parks, manufactured home communities, trailer parks, whatever we want to call them. That's kind of your niche. Have you always been doing that in real estate, or did you start off somewhere else and move into mobile home parks?
I did, yes. And, the transition from athlete, that's tough. I don't need to get too long-winded on that, but, when that day ends, you don't have, I didn't have an IB degree or finished college. So, it's tough for a lot of athletes. And, really what sparked the real estate was my last season. I was at a pro camp trying to get picked back up into an affiliate team. And one of the big leaguers was there saying, hey guys, this day's going to end someday, right? Don't get depressed. Don't get on drugs, alcohol. I didn't even make my millions in baseball. I made it owning thousands of apartment units. And I was like, and it just, it didn't click, but it was like, okay, I've been interested in.
So that was the professional player was telling you guys, I didn't make my millions in baseball. I made it in real estate.
That's right.
So that's where the light bulb went off.
Because I've always had, I just like skyline buildings. I didn't have family in it. I mean, my dad owned one rental, right? His mother's, and it was more horror stories. They stole the fridge. So I didn't get that passion. But that was my 2 years before I ended. And then it kept hitting me, today I still get, goosebumps. But, long story short, once my day ended and injury, had a beautiful 8-month-old daughter at the time. I said, I got to get in the real world. And I kept thinking of that. And I asked my father, I'm like, I want to own apartment buildings. I don't even know how. I don't have a trust fund. I don't have a big signing bonus, but how do I get involved? And he did know a developer of apartments. And at that time, I had just got a real estate license because I didn't know what else to do.
Yeah, what to do.
For your listeners, depending on where, you don't always have to go that route, get a license. Most operators don't want the license for a lot of reasons, but I did go that route. I ended up working with some larger commercial outfits, Marcus Millichap, just really learned the apartment space because that was always my sweetheart. I was like, I want to own thousands of apartments. And I did that, for a number of years until I said, hey, I want to go off on my own, go independent and start selling, but also trying to own and operate. I was starting to figure out pieces little by little. And that's why these podcasts are great, Dave, because you learn something that maybe you didn't even know was, what the heck's a syndication, right?
Yeah.
So I did, I got into the multifamily, and in about 2018, I kept hearing these mobile home parks. I'm like, what? Like, you don't even think about them. You drive by, they're not sexy. They're just a little sleepy. But I noticed the default rates were the lowest across, major food groups with default rates. And obviously, as I'm raising money, investing money, I'm thinking, well, what's the safest asset class? And I'm sure people can argue, but that's really when I took the turn into mobile home parks, about 2017, 2018. And I hadn't owned anything at that point, zero. So that was really the moment I took a pivot and started really diving in on the mobile home and affordable housing space.
Okay, so that's about, at the time we're recording this, about 8 years ago. And fast forward to today, what does the portfolio currently consist of?
So we just crossed the 2,000 unit mark across 26 communities. I say I have a business partner, which is a funny story in itself, how we met on my brokerage days. And that started with one deal. That first 68 unit, there was a 2-part mini portfolio in Southwest Little Rock. In 2020, we bought that and just started picking up little, small, mid-size, and just once you get that first deal, it's right, the law of the first deal. It took us about 18 months, stacking on 3 to 4 years, and me just getting my teeth kicked learning and trying to figure out how to get going. But yeah, we've grown in decent size, and we're growing and going through all the pains of learning the different levels, employee, self-integrated property management. So it's blessed to be busy. But
most definitely. Okay, now I was looking a little bit on your website. Are you focused primarily on the state of Arkansas? Is that the primary market that you focus on?
Yeah, we currently, it's funny, we're the largest owner of ours. My business partner always jokes, that's like saying we're the tallest midget. Who cares? It's ours from 1,000 years, not that big. But what we noticed was, I'm here in Florida, and he owned a park. Tyler's his name, and I met him through a cold call. He owned one park. I was trying to find opportunity here. He's like, "Who the heck is JP Capital?" That was my first company. Hung up on my face, called him back, because I didn't get out what I wanted to say, and we ended up meeting, and we tried getting deals done for about 18 months together in Florida, and this was 2017. So market was crazy. Guys were putting $100,000 non-refundable day one on a 4.5 cap, which to your listeners, if they don't know, that means that price is really high. So we couldn't get a deal done, and there's a wild hair out in Little Rock, and we saw that there was a lot of opportunity that was overlooked there. And so once we got in the market, brokers weren't calling into that market. The sellers were telling me, "Are you sure? Have you been by this property?" And I'm thinking like $1 million for 68 units in Florida. It's like 5 million, so it is getting more competitive now. Fast forward, it's getting more competitive. But that's really what kept it going. And then we just kept picking up little deals and growing, and just said, "Hey, we're set here now." And we did a deal in Illinois, and we're opportunistic, but we just didn't want to get too far ahead of ourselves, spread too thin across other markets.
Okay. So what percentage of your portfolio is in Arkansas? Is it
1,100 of the 2,000 are in Arkansas, and that does consist of one apartment building. It's a 60 unit, but all the other 25 deals are mobile home parks. So
very cool. Very, very cool. All right. I'm curious, because you spent a number of years in professional sports. You mentioned that you didn't go to finish college because you jumped right in the whole sports thing. I would imagine that, there are some transferable things that you learned in sports that you bring to the business of real estate. What kind of pops into your mind as one of the things that you really appreciate from baseball when it comes to what you're doing now?
Yeah. And, I heard that early on, where I'm like, oh, because when you start getting some people will start saying, "Oh, yeah, athletes do well in this or that." And like, okay. And then, but now I really see a lot of those, 4 a.m. workouts, like the discipline, the competitive drive. It's a Shark Tank out here, so, and it's cutthroat, unfortunately. We do business the right way, but we're watching ourselves, and we got to compete with a lot of people. And so having that drive, and just to relate it to baseball, right? When I played, I was a pitcher, but baseball, if you're hitting 300, that means you're successful 3 out of 7 times. So if you translate that in the real world, and you're a superstar at that, right? So failing, so getting comfortable or used to saying, "Well, hey, I just failed 7 times. That out of 10, that's, if you're in the real world, just get your tail kicked 7 out of 10 times. That can be discouraging. Right? So I think the mindset just of, hey, I got to go out there and perform no matter what. And I had great coaches that always, because a lot of these guys, their heads can get bigger than can fit through the door. Right. So having an even keel, knowing, hey, I could be the superstar today, but tomorrow I could get humbled and lose the game for everybody. And just showing up day after day with, especially in our world, we eat what we kill. Right. Nobody's giving us a paycheck here. So having that, hey, I gotta perform and go get it. That's how it was in the real world. They throw you the ball, and that could have been your last game. You're out of here, and Jack. Right.
Plus, I guess now that you guys are scaling up your employee count and your staff and whatnot, the whole idea of being a team player versus a solopreneur kind of thing, probably playing in team sports for many years helps with that a bit as well.
That's a great point too. And I'm recognizing that a lot now, because like leadership, there's guys you see out there football, like Tim Tebow was a great leader, for Florida Gators, played football and even baseball, but having the leadership mentality, employees are tough, that's, and being able to lead by example, right. And everything else it is all relative. So there's a lot of good translations and a lot of it, just the mindset, that's it.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
All right. So you touched on a few things that you really like about investing in mobile home parks. Maybe give us a little synopsis. What are your favorite things about this investment class?
Yeah, so one of the big ones early on, after underwriting all of these and then evaluating the apartments, right? Just doing the numbers, talking with these owners and seeing, and apartments are beautiful. I love them, but seeing the renovations, the challenges with some of those, where once I heard that if you just own the dirt and the resident owns that home, you're not fixing, the three T's, was it toilets, tenants, termites? In full disclosure, it's not that simple, just owning the dirt, for the record. But that was something that I recognize is, okay, well, if we own the dirt, if we can sell the homes, the retention for that resident, if they own that home is much greater than just renting it and leaving up tomorrow, because there is some ownership. So that was huge just in itself. And then the default rates, when I was studying, I had a lot of data and great resources at some of these larger commercial outfits that I was part of, and just seeing what the default rates are. You got office, retail, industrial. There's so many food groups, and there's great car washes, small bay, and there's so many great assets. But I mobile home parks kept coming up as the downturn. What's performing best, because it's cyclical. If we're up here, we're coming down at some point, and it's going to go up. So I looked at the bottom, like when the markets fell, what was performing well historically, and it kept coming up. One of the number one, there's self-storage and mobile home parks, and the apartments, office would get a little bit. But those are really the two big ones for me, as resident ownership and default rates were very low.
Okay, very good. So it sounds very appealing, but nothing's perfect. So what are some of the downfalls, the downsides to this particular investment class?
Yes. And that's a good one to talk about. I don't like just talk about all the great, because it's
not all sunshine and flowers. Yeah,
it is not. And so we're still responsible for the infrastructure. And a lot of these parks we get into, I don't know if you've ever heard of Orangeburg, or if some of your listeners out there, Orangeburg, I think it was the 70s, or it was the worst invention ever. It basically like dissolves this pipe for sewer under the ground. And so we'll come into some parks, we do our due diligence very thoroughly. Not saying we've never have missed something before, but even if the infrastructure is good, like sewer, water issues are always the biggest one. Like our biggest line items are typically water, and when we come in trying to not just bill back that to the resident, right? That's not fair. We come in, but there's always issues with that, especially our product type that have been typically mom and pop, owned them for decades, no capital expenditure, no renovations, and we've walked through a lot of mess, and it's revolved a lot around the water lines. We just replaced, actually, at 195 sites, the entire community. Fortunately, we planned for it. It was a $650,000 investment to replace the entire water line. So that can be a huge challenge. And then, I talk about the residents owning their own home. That's beautiful. That's what we want always. But a lot of times there are park-owned homes where the park owner owns those, and they do treat them as a rental. So they are responsible for fixing everything. And some owners will argue we're crazy to give up $700 or $900 for a rental to just collect. We average $425 lot rent, and they're like, "What are you guys doing?" We said, "Well, we don't want to maintain that unit." So the conversion of those park-owned homes into a tenant-owned home, that's very challenging. It's not as easy as I thought. Sometimes it works. Happy birthday, Merry Christmas. You got a brand new home, and they're out of there. Even if you give them a home. So it's not that's a big challenge too. Is just
So sorry, even if you give them a home, so a current resident, you say, hey, we're going to turn you into an owner. You own this place now. Yeah, I can see that being a challenge because they've been a tenant forever in that same place. So they don't have, but I would think doing a rent to own, but you'd have to get somebody new in there. That would probably work really well.
That does work great. And that was what I was going to say is the best business model for this. And we haven't figured out exactly, because I would think, hey, I've got a brand new home. I'm pretty much saying on the same. And I don't know if it's like their mindset. They just freak out and they'll leave and just abandon. And we don't know. But the rent to own works very well because that they're still in that renter. It's in the agreement. Hey, you are renting it to own, so you are responsible. But they're renting it. Payments are. And there's
plus they typically put up a fairly decent deposit up front to get their foot in the door, so they're much more serious.
So that's the best way to convert those, and they'll still leave, but then that's when we present that to the new prospect or tenant resident, then they know, hey, this is a rent to own. They come in fresh with the deposit, and it's there's better retention, but that's a challenge always with park-owned homes for sure.
Yeah, I can see the water systems, like the infrastructure part of things being a challenge for sure. Very, very cool. So Jason, now that you guys have 20 plus communities under your belt, I would imagine capital is a big part of this. What have you found works best for raising capital for these deals?
That is the magic question. And I listen to your podcast, and I hear you have great capital raisers on. And with us starting at a small, even 60 units, I used to think that was huge at one point, right? So in the mobile home park world, we bought a 33 unit for $375,000.
Wow.
And so from a banking standpoint, nobody wants to touch it.
They don't want to touch that. Yeah.
And then, so early on, we did have, I had an investor. My first investor actually didn't realize he could even convert his 401k into self. And he didn't have the time. He's working 80 hours a week. But I had the time to find deals. So we started finding those partnerships because the banks, we had to do an owner finance on our first deal. Then we strung a little capital together because, again, they were smaller deals. And that was the friends, tapping into the network. But with no track record, that's challenging too. It's not like we just started I didn't even know the syndication structure at that point. I heard some JVs but as we've grown and getting out there like this, social media, just being on LinkedIn and seeing a track record, not pushing a deal. Hey guys, I got this great deal, 18, 20% IRR, like just showing the good, the bad, the ugly, just to build that trust, which I hear a lot of you guys, that's it. Find friends, build trust, and people do business with, who you know, like, and trust. And so that having that track record and then starting with the smaller deals, we were raising even a minimum investment at $25,000 a deal. So now, you can imagine the K1s can be a nightmare.
Yeah, that's a little bit of a pain, that's for sure.
but we love that, and that built our track record. And then fortunately now, Tyler, my business partner I mentioned, out of those 26, we own seven of those communities, just him and I. So once we got to that stage, we could then leverage that. That's been our basically. We don't take, I told you this, not to advertise it, but I do like people to know, like, oh, just because you're sitting on the hundreds of units, it's not like we're just taking all this money, going buying Ferraris. Like, we're investing in our business, every penny, and employees. So, but recently we just closed 850 units. It was our largest deal to date, 13 million. We did actually buy it out of bankruptcy, and that was our largest deal to go raise, 6 million. Was bigger for us. That's still small in the grand scheme of things, but a lot of those were investors that had seen us over the last 5 years, and they've been on a list from whatever it was, a webinar or just watching us. And then, it's still been hard. I'm not gonna, sugarcoat it, but and our deals have been significant value add, tough. It's not like we're just, hey, next month you're getting a distribution. It's, hey,
right. You got to wait a while. Yeah.
Yeah. So but yeah, right now, and we are getting bigger deal flow and to get to our 10,000 units, we're at 2,000, have a long way to go, but we're realizing the bigger deals, the money does come. I don't want to say easier, but equity debt brokers, they're more incentivized, obviously, to help with that. And, family offices, that's another network we've really, just the last 18 months have focused our efforts in because they align with our goals. We're not fix and flip guys, nothing wrong with that, but family offices, they're there to preserve their family's wealth. And so,
Right.
Instead of just guys coming in, we want to flip this and run, it's aligned, and they're bigger check writers. So that's kind of where we're at this point.
Oh, that makes a lot of sense. Well, that's fantastic, Jason. So as we're wrapping things up here over the next 12 to 24 months, where do you guys see your company going?
Yeah, we never like to pause on deal flow because our deal flow has always been great. We've been blessed with good deal flow, but operationally, like our focus this year, we did close at 800. That's keeping us busy, but we're at about 26 employees now and growing, and just really trying to dial in our operations is our focus, at least these next 12. And we feel once we do that, we're stabilizing some projects, have some refinances, then in that next 12 months, we feel we'll be able to take bigger bites out of deals and really grow, even if we pull back, let's say, on deal flow. But we're
very, very, that makes a lot of sense. Kind of dial things in first. All right. And then, Jason, who are you looking to connect with? Who are the kind of folks that you like to connect with most these days?
Anybody really interested? We touched on athletes. That transition is tough. So anybody, and it doesn't have to be athletes, of course. Anybody, they could have been working a career their entire life, and somehow that got pulled away with, call it AI or whatever it is, and just being in that position of, what do I do? Maybe I had some interest. Like I heard that apartment guy tell me he didn't make his millions, and just to connect with people that have an interest, whether that's on a passive or active level. We're happy to send deals. There might be that weekend warrior out there that says, hey, I can buy a 30 unit. We got deal flow. I do run a brokerage out of Florida, boutique myself. So we're happy to send deal flow. It's an abundance deal. There's no secrets in this. It's hard work. That's the secret for everybody listening. So just, anybody who's interested in commercial real estate and, in investments and as it relates to, multifamily affordable housing, that's who we serve the best.
Fantastic. So, Jason, if people want to reach out and connect with you, where should they go?
I am on Instagram, the Jason Postill. That's the Jason Postill. That's me. That'll have all of our websites there. So that's probably the best way to find me.
Fantastic, Jason. Hey, well, keep up with the good work, and thanks for being on the show.
I appreciate it, Dave. Thanks for having me on.
All right, everybody, take care, and we will see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.